So, topic number one, business taxes. So Trump is proposing lowering the corporate income tax rate from 21 to 20%. And since this has been published, he's actually done one or two interviews last week, I think it was, where he actually wants to move it from 21% to 15%. What this is talking about is the corporate income rates. That's for C corporations. So most companies in America are pass-through entities, meaning that they don't pay taxes themselves. The income passes through to the individual owners, and the owners pay taxes as part of their whole tax picture when everything gets combined. C corporations, though, they stand alone. So they have their own income, they have their own expenses, they have their own income taxes. And so before the Tax Cut and Jobs Act, the tax rates on corporate income were in the 30s. It was like 35%, I think it was. And that was a huge problem because in order to get money out of a corporation, like if you're an owner of a C Corp, whether it's a closely held C Corp or whether it is like you own a share of Apple Computer, which is also a C Corporation, all stocks trading on the stock markets, those are all C Corps. In order to get money out of that, you have to take a dividend. And the C Corporation does not get to deduct that dividend payment as an expense. So let's just say C corporation brings in $1 million and has $1,000 of expenses. We got $300,000 net. So that $300,000, the C corporation is going to pay tax on that. And then if you take that 300 out as a dividend, the person receiving the dividend is then going to have to pay a dividend tax on that income. So it gets taxed twice. It gets taxed at the corporate level, gets taxed again at the dividend level for the individual. And if you've ever heard about double taxation, that's what it's talking about. So under pre-2017 or 2018, really, it was 35% at the corporate level, and then at the individual level, you're going to be paying, either 0, 15, or 20%, or maybe 24%. So at the higher levels, you're talking about 55, 60% plus state tax. So it was hugely punishing to have corporate profits, basically, and to take dividends from corporate profits. And so that's really what started the financial engineering of stock buybacks, because that was a more efficient use of capital for companies compared to issuing dividends. That has had all kinds of bad effects on the stock markets. Well, bad effects as far as I'm concerned, because companies got more interested in playing with the numbers rather than generating real profits. But that's a whole other conversation. In the Tax Cut and Jobs Act, which was the Trump tax reform in 2017, they lowered it from 35% to 21%. So there's still the double taxation. So 21% at the federal level for the corporation, plus the dividend. And the dividend you might be paying 0, 15, or 20%. So if you take a middle case, 21% corporate, 15% individual, you add those two together, now you're talking 36%, which is comparable to the highest individual rates of 35 and 37%. So by pushing the corporate tax rate down, it brought the net dividend benefit in line with just regular other income. And so that's where we are currently. And the Tax Cut and Jobs Act is going to be expiring here in a couple of years. And once it expires, rates are going to go back to where they were before. He's talking about lowering from 21 to 20 and possibly to 15, like he said in his recent interview. And that would just make it that much more attractive, one, to have C corporations, and two, to take dividends out of them. Is that a huge shifter as far as how much do you want to have a C corporation versus an S corporation or partnership or whatever? It's going to move the math a little bit because there is a break-even number, basically. When we look at setting up clients with especially new entities, there's some math that goes into it. It's how much are you making and how do we want to treat that? And basically, just as a rough number, if you're making less than $500,000, usually it's better to be a pass-through, like an S corp or a partnership. If you're making over that, a lot of times the math switches and you're looking at better off being a C corp. It also depends on what you want to do with your company. So if you plan on selling your company and you want to take advantage of some of the incentives to sell companies that are in the tax code, like 1202 exclusions, then you want to have a C corporation. There's a lot of considerations that go into it. By reducing the corporate income tax, you make it a little bit more attractive. That's the net result there.